Today, I want to tell you a story of two of my close friends, Aisha and Ravi, two college students who both got their first credit cards. And Aisha used hers responsibly, paying off the full balance every month and building a strong credit score. Ravi, on the other hand, swiped his card for everything, ignoring the minimum payment warnings and racking up debt. A few months later, Aisha had a great credit history while Ravi was drowning in high interest payments and regretting his decisions. Understanding credit cards and debt is crucial. If used wisely, a credit card can be a powerful financial tool, but if it's misused, it can become a painful financial burden. Hi guys, my name is Parul. I'm an economist and I make videos on this channel to promote financial literacy. In today's video, I will share the do's and don'ts of the credit cards, how to avoid debt traps, and how to build a strong financial future. I will also answer some commonly asked questions. So let's dive right in. Okay, let's start with the basics. What exactly are credit cards? Simply put, a credit card allows you to borrow money up to a certain limit, which you must repay either in full or with interest over time. Okay, here are a few terms that you need to understand here. There's something called a credit limit, which basically is the maximum amount you can borrow. Okay, next is the interest rate or APR. This is the cost of borrowing if you don't pay in full each month. Then another important term is minimum payment. This is the smallest amount required to keep your account in good standing. And many credit card companies just require you to pay the minimum payment so they can get more interest out of you. Lastly, the rewards and perks. Most credit cards will either give you some form of cashback, airline miles, or discounts. So if Ravi spends $1,000 on his credit card and only pays the minimum balance of $25 per month, with an interest rate of 20%, his total repayment would be over $2,000, and this can take up to 5 years. So always pay the statement balance to avoid interest charges. Use less than 30% of credit limit. This will help you maintain a good credit score, and avoid late fees by scheduling automatic payments. Understanding credit score. Your financial report card. A credit score is a 3-digit number from 300 to 850, which lenders will use to assess your credit worthiness. Several factors affect your credit score. The most important one is your payment history. This has about 35% weightage in determining your score. On-time payments always boost your score. Second one is credit utilization, which has 30% weightage in your credit score. Keeping credit card balances low will help you. Third, we have the length of credit history, which carries 15% weight. So older accounts improve your score. Next, we have types of credit cards and loans you have. So this also has 10% effect on your score. And then lastly, new credit inquiries has 10% effect on your score. So too many applications will hurt your score. Now let's look at the main reasons why you should try to get a good credit score. First, it will give you lower interest rates. When you want to borrow for a car, mortgage, or another big purchase, it'll help you. Also, it will give you easier loan approvals because banks trust responsible borrowers. Similarly, you will get better rental opportunities because landlords check credit rating before they lease. And lastly, some employers check credit history for financial stability. So a good credit score gives you better employment prospects. So there are some ways you can improve your credit score and keep it above 750. Always make payments on time. Even one late payment can hurt your score. And then keep balances low, which means you only use less than 30% of your credit limit. And maintain older accounts, so the length of credit history matters. And limit hard inquiries because applying for too much credit at once can lower your score. So once a year, you should check your credit report from the 3 free available websites. In this section, we will learn about the common credit card mistakes that many people make, okay? So first is carrying a balance, or in other words, paying only the minimum, which leads to high interest charges over time. So right now, it is as high as 24%. Secondly, by ignoring statements, you can easily miss any hidden fees and unauthorized transactions. And thirdly, opening too many cards leads to overspending and a lower credit score. So don't get too many store credit cards if they ask you to, if you don't specially shop at them frequently. Now, by if you are in credit card debt, you can get out of it by using either the debt avalanche method or debt snowball method. More on these two methods you can watch in another video, and I have put the link of it in the cards above. Or you can use a balance transfer. So sometimes it makes sense to transfer your credit card balance to another credit card which offers an introductory 0% for the balance transfer. But remember, you cannot use it for any new purchases because that one will still apply with the current APR. Okay, in another video we will compare debit cards and credit cards. And so this is all for today's video. I hope this information helped you, and let me know if you have any questions. My name is Parul, and I will see you guys in my next video. Take care. Bye.